In today's unpredictable market, it's becoming clearer that we may be nearing another financial downturn, one that could echo some of the most disastrous crashes in history. There's a sense of complacency right now, much like the calm before a storm, and it's making many experts nervous. Markets are soaring, but if you dig beneath the surface, there are cracks in the foundation that investors should be paying attention to. Jeremy Grantham, a highly respected investor and co-founder of GMO, has been sounding the alarm, warning us that the stock market is more fragile than it appears. He's not just talking about a minor dip. He's drawing comparisons to some of the worst financial collapses we've ever seen, and that's something we can't afford to ignore. Grantham argues that the current market is fueled by irrational euphoria, not by solid economic fundamentals. If we look back through history, this isn't the first time we've seen this kind of exuberance, and it's rarely ended well. Grantham points out how similar today's market feels to the periods leading up to catastrophic crashes like the 1929 Great Depression and Japan's market collapse in 1989. In each case, the market appeared unstoppable, and investors who failed to recognize the warning signs suffered devastating losses. Let's start with the 1929 stock market crash. In the years leading up to that infamous day in October, the United States was thriving. It was the roaring 20s, and everything seemed perfect. Industries were booming, people were spending like there was no tomorrow, and the stock market was breaking record after record. But what most people didn't realize was that this prosperity was built on shaky ground. Many investors were buying stocks on margin, essentially borrowing money to buy more stocks. It was a gamble, and for a while, it paid off. But when the market started to wobble, this practice triggered a cascade of selling that caused the market to crash. In a single day, billions of dollars vanished. That crash wasn't just a bad day for the stock market. It was the start of the Great Depression, a decade-long period of economic turmoil that affected millions of people around the world. Now, fast forward to 1989, when Japan faced its own financial disaster. Much like in 1929, investors were caught up in a frenzy of optimism. Stock prices were soaring, and the real estate market was in a bubble of its own. The Nikkei 225, Japan's stock market index, hit an all-time high of over 38,900 points. But, as Grantham warns, when you're riding a wave of irrational optimism, it's easy to overlook the underlying risks. Rising interest rates and slowing economic growth burst Japan's bubble. The Nikkei plummeted, losing over 60% of its value, and the fallout was felt for years. Japan's economy stagnated, and the country's financial system was shaken to its core. If these two historical crashes teach us anything, it's that markets don't collapse when everything looks bad. They collapse when everything looks good. And that's what makes Grantham's warning so chilling. He sees the same dangerous mix of overconfidence and speculation in today's market. Investors are throwing caution to the wind, chasing gains without considering the risks. They're betting big on tech stocks, pouring money into companies like Apple and Microsoft, whose valuations are sky high. Take Apple, for example. It's valued at over $3 trillion, a number so massive it's hard to even comprehend. While these tech giants have certainly delivered impressive returns, it's worth asking whether their stock prices are truly sustainable. Grantham argues that these companies are trading at inflated prices, and history tells us that what goes up must come down. If you're finding this breakdown of market history insightful, now would be a great time to like this video and subscribe. Doing this will allow you to stay informed on the latest market trends, financial insights, and strategies that help you navigate this ever-changing landscape. The parallels don't end with past market crashes. Grantham also points out how today's market resembles the housing bubble that led to the 2008 financial crisis. Back then, investors were convinced that real estate prices could only go up, and when the bubble burst, it sent shockwaves through the global economy. Banks failed, people lost their homes, and millions were left scrambling to recover from the fallout. Grantham believes that today's market is heading in a similar direction. Rising interest rates, geopolitical tensions, and the risk of a recession are all looming threats, yet investors seem to be ignoring them. They're buying stocks at high prices, convinced that the market will continue to climb, but history suggests otherwise. Another factor contributing to the fragility of today's market is the growing disparity between rich and poor. Much like the period leading up to the 1929 crash, the wealth generated by today's stock market boom is concentrated in the hands of a small elite. While a few are raking in massive profits, many others are struggling to get by. This widening gap between the haves and the have-nots creates a shaky foundation for the economy, and as we've seen before, this kind of imbalance can lead to serious social and economic consequences. Grantham isn't alone in his concerns. Even Warren Buffett, one of the most successful investors of all time, has been sitting on a massive pile of cash, waiting for the right opportunity. Buffett is known for his cautious approach, and his decision to hold off on big investments right now speaks volumes. He believes that the market is overvalued, and he'd rather be patient than rush into investments that could backfire. Buffett has often compared investing to baseball. Sometimes it's better to wait for the perfect pitch rather than swing at every opportunity. His massive cash reserves show that even the smartest investors are being careful in today's market. As we look ahead, it's impossible to predict exactly when the next market crash will happen. But if history is any guide, we should be prepared. Jeremy Grantham's warning is a reminder that markets don't rise forever, and when they fall, the consequences can be severe. Investors should consider hedging their bets, diversifying their portfolios, and perhaps keeping some cash on hand for when the market eventually corrects itself. As the saying goes, it's better to be safe than sorry. Thanks for sticking with us through this informative insight into the history of market bubbles and crashes. If you found this content valuable, don't forget to like the video and subscribe to our channel, Economic Hero, for more insights into the world of finance and investing.